Hi guys, I welcome you to my course on managerial finance, and this presentation will briefly cover the overview of what is coming up in the course during the entire semester. So to give you a general introduction and information about the course will be online and I'll be teaching on Friday 4 to 5 p.m. There's a little change in the schedule and that will be online, and this is my Zoom online class uh, Zoom link. So you can log into the link, and I'll be holding office hours on the same day during 5 to 5:30 p.m. The software that we're gonna use in this course is Microsoft Excel. And these are the course objectives. We will understand the corporate goals and the environment within which the financial function is performed. So the main goal of business is to maximize the wealth of shareholders or stakeholders. So how this course will help in achieving one of the main goals of the corporate finance. We'll also analyze the financial performance using ratio analysis. We'll also look at the cash flow statements, financial statement, and also we'll calculate and analyze securities valuations. And we'll talk about time value of money, which is one of the most important idea in managerial finance. And based on building upon the idea of time value of money, we'll use the idea in calculating and analyzing securities valuations, where we will discuss models and theories which being used in stock valuation. And also we'll talk about the bond valuation as well, and we'll use the tools that we learn in stock valuation and bond valuation to determine the cost of capital, which is an important idea, which is cost of capital is being used and is considered as a risk factor or risk rate to discount the free cash flow. We'll then go on to understand the risk and return, the return and the risk, especially diversifiable and non-diversifiable risk, and also we'll talk about asset pricing model. And we'll also learn importance, role, and techniques of capital budgeting techniques, those techniques are useful in selecting the best project which require huge outlay. So the decision of capital budgeting related to fixed assets decisions. The course assessment consists of, I will use assignment, midterm exam, final exam, which each of the midterm and final exam carries a weight of 30%. Quiz will be of 20% weight, so the total is 100%, and those will be posted on Mind tab. And I also posted a video, introduction video, where that will help you to register for my course. So the quiz and assignments and exams will be posted on Mind tab. The structure, the first half of the course structure covers before the midterm, we'll cover financial management overview, then financial statement and cash flow analysis, and also the time value of money. And there will be one lecture on applied review if the time permits, and the midterm will cover the 4 chapters. And the structure of the midterm will be the kind of multiple choice question, Excel applications. So we'll be, throughout the semester, you'll apply Excel to analyze the financial data. So in midterm also, either you'll be given an Excel problem, one of the questions from the total questions, or few of the questions requiring Excel applications. So you'll be using data, using Excel, solve the problem. The later half of the course covers bond valuation, risk and return, stock valuation, cost of capital, and capital budgeting. And there will be a special assignment quiz on Mind tab. So let's begin with the first chapter, an overview of finance. What we're going to cover is this: the overview of finance. In the corporate finance, the knowledge of managerial finance is important because it provides the skills that provides the knowledge of corporate the skills that the knowledge of corporate finance provides. So it's kind of how business are organized, what are the primary goal of firm is, how managers can contribute to attainment of these objectives, what kind of conflict arise between managers and stakeholders and bondholders, and how to balance the shareholders' interest and the interest of society. And that also touch upon the business ethics when companies are doing and the consequences of unethical behavior. So the topic on this topic essentially cover the area of managerial finance and broadly, and also it talks about the main objective, that is to maximize the value of the firm, or a manager should endeavor to enhance the value of the firm. At the same time, they should not forget uh, their responsibility to a society and stakeholders. Um, uh, another theme of the course is on financial statement and cash flow. And as you know that their objective of the firm, objective of the business is to maximize the intrinsic value, and the intrinsic value is that depends on free cash flow. So it is important that you understand the key financial statements and identify the kinds of information they provide to corporate managers and investors. And we'll learn how to estimate a firm's free cash flow and explain why free cash flow has such an important effect on firm's value. We'll also talk on the analysis of financial statements, and you know the importance of financial statement analysis is comparing firm's performance, evaluating the firm's financial position, and that knowledge will help you to know if the company is good for investment, and that is also useful to managers to identify situations needing attention. Right? Potential lenders use financial analysis to determine whether a company is credit-worthy, and stockholders use financial analysis to help predict the future earnings, dividend, and free cash flow. So this chapter will explain the similarities and the difference among them. I believe none of the chapter is more important than time value of money. So what is time value of money? That dollar in hand is worth more than a dollar to be received in future. Because if you had it now, you could invest the dollar and could have earned some interest. And of all the techniques that is used in finance, we'll use the time value of money idea, and that is called discounting the cash flow. And the future, this time value of money chapter will teach you how the future value and present value techniques can be applied to single cash flow, that is a lump sum cash flow, ordinary annuities, annuities due, uneven cash flow, and will calculate the future value, present value, the rate of return, or the number of years required to reach to your financial goal using financial calculator or Excel spreadsheet. Largely, we'll use Excel spreadsheet. The build on the idea of time value of money. We'll also understand the bond valuation, and bond represents. This chapter presents a discussion of key characteristics of bonds and using the time value of money. And you know that bonds are one of the most important types of securities to investors, and bond is valued. If you buy a bond as a bondholder, you'll get income, cash flow in the form of coupon payment and maturity value at the time of maturity. So the present value of the bond is the present value of the cash flows, and that this present value of cash flow, there are two components: is the present value of coupon payment and the present value of maturity value. And in addition, we'll understand how to determine the yield to maturity, because bond holders they demand the return. And the return expectations by bondholder is the cost of the company. So it is very important for the firm and for investors to understand how the bond is being valued and cost of the bond is being determined. We'll also talk about the risk and return. All right, the investors, here we start with the basic premise that investors like returns and dislike risk. It doesn't mean that you know they don't want to invest in risky assets. They will buy their the assets which is a little riskier, provided it offers them premium to reward the risk they have undertaken. So this here the discussion of risk and return and the relationship to show how those risk and return interact to determine the security price and portfolio. And as an investors and managers, they should understand how the risk and return being quantified, because what is measurable is manageable, right? So we'll see the tools that those are available to capture the risk and return. And the knowledge of risk and return will be useful to investors to take the best decision, best and appropriate investment decisions. Going further, there is another security that is valuable or being used to raise the capital and also for an investors to invest their money, and that is stock valuation. So this chapter focuses on how much the company worth, what can managers do to make a company more valuable, and how the stock's price are determined, and why are stock price so volatile. So using dividend growth model and market multiple, we'll try to value the stocks, and also we'll estimate the corporate valuation. Once we establish and when we learn how to value bond and how to value stock, our next step is to determine the cost of capital. This cost of capital is a critical element in business decisions. Company, it is a factor that is used in compensation plan, and that can be used is a factor that can be used to evaluate many investment proposal. So cost of capital is a key factor in choosing the firm's mix of debt and equity, because the weighted average cost of capital is the weighted average cost of components of capital. So let's say you use equity and debt in the capital structure. So the cost of capital is the proportion of equity times the cost of equity, and the proportion of debt times the proportion of debt being used to raise the capital. So that cost of capital represents a minimum return the company must earn in order to meet the cost of the business. So it is very important and important to determine the cost of capital, because all the projects being evaluated against this cost. Okay. Once we so after talking about cost of capital, we will also explore on capital budgeting, which is one of the most important processes of evaluating the projects and dividing which one to accept, and thus include the capital budget. So that is the chapter discusses various methods used to evaluate projects. So we'll discuss various methods that consider time value of money and method that doesn't or do not consider time value of money. So we'll talk about NPV, internal rate of return, and modified internal rate of return, which are the weaknesses and limitations and strength of each method, which method is used when. So all we will be focusing on those area of capital budgeting. We'll also, touch a little bit about how to estimate the cash flow and evaluate the project risk. And this is the big picture, right? This is the big picture I was talking about. And using this big picture, a manager's primary goal is to maximize intrinsic value or make the company more valuable. But how exactly does one go about doing that? The equation in this figure, this is the equation in this figure, shows the intrinsic value is the present value of free cash flows discounted at a weighted average cost of capital, right? Uh, so 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 it means that the value of the firm depends on the size of the cash flow, that is bigger the better. Timing of the cash flow, so the timing of the cash flow, earlier the better. And the riskiness, right? Less risk is the better. So the value of the firm depends on the free cash flow and the risk. And there are two approaches for increasing value of the firm. One is by increasing free cash flow, and the other one by reducing the risk. All right, um, and observe that several factors affect free cash flow, and several factors affect weighted average cost of capital. So in this rest of the topics that we're going to cover during the semester, we'll typically focus on those factors and the tools that you will use after graduation to improve your company's intrinsic value. And I believe that it is true that every manager needs to understand financial vocabulary and be able to apply financial tools, but the successful managers also understand how their decisions affect the big picture. So as we go uh, further, keep in mind where each topic fits into the big picture. So that is the process is known as discounting, and that we learn in time value of money. You're discounting free cash flow with the risk. And weighted average cost of capital is the cost of capital, where how those cost of capital is being determined is the cost of debt and cost of equity, right? So that is the return demanded by debt holder, and that is the return demanded by equity shareholders, and the uh, mix of debt and equity that also influence the cost of capital, right? Uh, and the firm's business risk, aversion to risk, so the more risk and using the risk and return relationship, we'll also learn how they interact and how they're being useful to investors so that they can take an appropriate decisions. So that's all about the introductory part of my course, what we're gonna cover during the entire semester. Um, and and if you have any question, you can always shoot me an email, or can I always welcome you uh, on my online office hours. Thank you.